Life certainly is different now, but one thing hasn't changed, and that's no matter who you are, education has the power to bring out your potential, to propel you forward, no matter your background, where you are from, or what you want to achieve. At NBCC, we're still committed to hands-on learning and instructor-led education, whether that's in person or virtually through connected classrooms. Just remember, education knows no boundaries, and neither should you.
So good morning, everyone, and welcome to this morning's Zoom webinar presented by the Chamber of Commerce for Greater Moncton. My name is Mireille Thibault. I'm the Promotion and Events Coordinator here at the Chamber. And this morning, we're very pleased to have Mariska Lewepke from IG Wealth Management, who will talk to us about tax planning for business owners. And Mariska is in Winnipeg, if I'm not mistaken, so it's very early there. So we're very happy to have you with us. Now, normally, most of these presentations would be at NBCC Moncton in person. We would have breakfast, we would be amongst each other, but obviously that isn't possible quite yet. We're hoping very soon. So nonetheless, I would like to start out by thanking NBCC for being our sponsoring partner again this year for our Breakfast and Learn series. And at this point, I would like to introduce Erin Cushing, who has a long title, Coordinator, Entrepreneurship, and also Research, Innovation, and Experiential Education at NBCC, to say a few words.
Good morning. Thanks for having us this morning. We're glad that we can help support the Moncton Chamber and businesses all across New Brunswick, and I'm happy to be here this morning. My title is just Coordinator of Entrepreneurship for NBCC. So that's part of my role, is helping entrepreneurs and businesses across the country and students who across the province, and students who are interested in entrepreneurialism as well. So I'm glad to be here. And as I said, NBCC is proud and happy to support this series. So thanks for having me.
All right, well, thank you, Erin. I also want to remind everyone that we will have a Q&A session at the end of the presentation, and you can pose your question at any time, and we'll try to get to as many questions as we can towards the end. And that chat button is found just at the bottom of your screen. So now, Mariska, she's a chartered professional accountant in the Advanced Financial Planning Department at IG Wealth Management, who provides tax and financial planning advice for clients. She spent 13 years working with an accounting firm providing tax advice to owner-managed business owners and high net worth clients. Since she joined IG Wealth Management in 2015, Mariska has worked with owners, managers of private companies on issues relating to tax planning, succession planning, and cross-border issues with a focus on US issues. She obtained her Certified Financial Planner designation and is a member of the Canadian Tax Foundation and Society of Trust and Estate Practitioners. And with that, I will turn the virtual podium over to Mariska to lead today's discussion. Mariska?
Thanks very much, everybody, for having me. I am going to share my screen first. And hopefully everybody can see that. And I'm just going to, I think that's good. So today's topic is planning for high net worth clients. And we're specifically going to talk about the tax strategies that I see making a real big difference for our high net worth clients. And we are leaning towards business owners. I know that a lot of you are working for business owners, or you're business owners yourselves. And certainly that is one of the prime groups of people, I guess, that come to us with usually, a pretty complex financial picture, and they're wondering, what does this look like when I retire, and how can I exit and pay for my retirement, live the life that I want? And so that's primarily the focus. I also wanted to spend a little bit of time today talking about some of the things that happened with the budget. And I know that probably got a lot of airtime in the last couple of weeks, but I do have some thoughts about things that I think business owners should pay attention to. And then some of the most common strategies that we see, like I said, when we implement them, they make a really big difference for our clients. So it's going to be a little bit of a potpourri in that sense. But I hope it's relevant, and we do have some time for questions at the very, very end. So hopefully we can get to those, and you will get a copy of the slide deck through the presentation. So if you're madly, furiously scrambling to take notes, don't worry, you will get the slide deck sent to you after the session. So I will just jump to the next slide here. Which is just a picture of me, and thanks for the introduction. It's been fun to connect with the people here in New Brunswick to try to get this session going, so that's good. The first part of the presentation, we're definitely focusing on business owners, and we'll get into that right away. And so we talked about this high tax environment, and I don't think anyone will disagree with me when I say we are living in a high tax environment. One of the things that we always look at as accountants and tax planners is there a really big difference to earning income individually or through a corporation? And so lots of business owners have money in their corporations that don't truly understand perhaps how that investment income is taxed. And a lot of people come to us and say, should I put my rental property in a business? And I always say, well, it depends. And that's a really safeguarded answer, but it really does depend. Do you already own this property personally? Are you worried about legal liability? How is that income going to be taxed, that rental income? And if you have that rental income being taxed inside the corporation, this chart shows that in the end, you'll pay almost 6% more tax earning that rental income inside the corporation. So, unless that rental income purchase is funded by an active business and you're taking advantage of some deferral opportunities, inside the corporation, then, probably not recommended. But are you really worried about legal liability? So it is very much a fact-finding experience when we get asked that question. Where's the money sourced from is usually the driver. But then, what's your exit strategy? Do you plan to live in that rental property down the road? Because then it's expensive to extract it from the corporation later. Those kinds of things. So we're always, through the lens of tax rates, we talk about, placement and where they're better off earning that money. And so you'll see, active income that's eligible for the small business deduction. There is a very large deferral available and, quite a minor tax cost in the end. And so does incorporation make sense? Yes. For most people who are earning active business income, you will take advantage of that deferral, and this is the reason why you would incorporate. There's a bit of an anomaly in New Brunswick right now, where actually there's a bit of a tax savings to earning income in excess of $500,000 inside your corporation. So by the time that you've paid what I call the first level of tax, the corporate tax at the business level, and then paid tax on the dividend that is coming out of the corporation at the eligible dividend rate, you actually pay a little bit less tax than if you earned that income personally. And so, that's kind of an anomaly. Like I say, that's not certainly the experience across the provinces, but today it happens to be that way in New Brunswick. And so what that says to me is, it is making sense to earn business income through a corporation. You get a nice deferral and you actually save a little bit of money. And so incorporation, I think, should be top of mind for anyone who's not incorporated and making money that they don't need personally. If you're going to extract every dollar and you need it for your personal living expenses, then incorporation might not make sense, unless, of course, you're worried about legal liability, and then don't sign any personal guarantees. So, there's lots of things to consider when we talk about earning money through a corporation. But eventually, most people do set up corporations, and they come to us and they're just, wondering what to do with their corporations and how that corporation can work for them during retirement. This is quite a sizable cost to earning investment income through the corporation. We'll talk about this in a little bit more detail. The cost is about half for capital gains because only half of our capital gains are taxed. And there's no cost to earning dividends through a corporation. So, even the type of income that you're earning from your investment portfolio inside your corporation can have a really big impact, on overall tax rates. And, the top rate is 53.3%. In the 20 years that I've been in tax, that is probably the highest rate that I've seen. We're facing the highest rates that we've ever seen. And that's pretty much consistent across the provinces as well. So, that's why tax planning is important, because we do have some choices out there, and ways to reduce taxes. There's some rules that came into play not too many years ago that make it a little bit more difficult, but there's still some things in our toolkit, and that's what we're talking about today. So that's kind of setting the framework for, why are we talking about tax planning? The next slide kind of gives you an overview of the budget, and it's very brief, but when we got the budget on April 19th, there was a lot of pages in that budget. It was about 700 pages, and right away I looked for a few things that had been speculated about. So one of the things that they speculated about, obviously, was the inclusion rate going up from 50% to something else. And the last time that changed was in 2000. And I have to say that speculation is always there, but it was there a lot this year. People were definitely expecting the government to change something, because how could they possibly pay for some of the spending that's been happening with COVID and everything? But I would say that the budget, obviously didn't include any changes to the personal corporate tax rates, which was probably a great thing for everybody. There was no wide sweeping changes. They didn't touch anything related to capital gains, nothing related to principal residence exemptions. That's a good thing. What I saw was targeted measures to either help a subset of people or to stimulate the economy. And there's lots of talk about, the COVID programming being extended. Just making sure that, sorry about that. The COVID program being extended. And there's also an introduction of a subsidy program. If you want to read more, we have a really lovely summary on our IG external website that goes into more detail. But one of the things that I think didn't receive as much press as maybe it should have is there's a very targeted measure for business owners that's available to you. This year, if you buy certain capital property, and it's mostly, capital property that doesn't have a very long shelf life, or, under the CCA classes doesn't. So it's things like equipment and manufacturing equipment, computers, things like that. You can buy up to $1.5 million of that type of property and write it all off in 2021. And so, if you've got a business owner that is looking to replace their whole fleet, or, has a large spend this is a welcome change in my mind. It is just a timing difference, right? You would normally get to write off that equipment over a number of years, and now you get to write it all off in 1 year. And so that received very little attention. And so I thought, I'd bring it up here because maybe that's relevant. You're working for a company that's looking at a large capital spend that could really help out. There's also some very targeted measures for people that are producing clean energy and technology. And then there's a significant tax reduction for zero emission technology manufacturers that was also found in the budget. And again, it's very targeted, probably not widely applicable. But if this is something that you want to read up on, there's lots of material on our IG website. The other thing that I thought was very noteworthy was that they're definitely enhancing the ability of the CRA to find out about tax planning. And so The mandatory disclosure rules were slightly changed. They've added some different measures that will make that a little bit stronger. So essentially, if you embark on what they call a notifiable transaction, you're supposed to let the CRA know that you did that transaction. Or if there's, a certain type of plan that you've implemented, you're basically also required to notify the CRA. And there's significant penalties that can be imposed if you don't, or if your, accountant who promoted this tax planning doesn't report it. They could also be subject to different penalties and things like that. The other thing that I thought was noteworthy was that the CRA didn't like losing a case a couple of months ago, and now an auditor can come into your workplace and they can actually ask for, an oral explanation from, anyone really to deal with, a relevant question. Well, I've always been a big proponent if the CRA auditors on your premises receive their letter with questions in writing and respond in writing so that you know exactly what they have, instead of, being forced to explain things verbally, because then they could ask anyone and maybe that person doesn't have enough knowledge to, you know, tell CRA exactly what's going on in that sense. So, I mean, there's certain things that they could ask, and if they can demand an answer right away, maybe you haven't given them a fulsome picture of what they need, and so that's the kind of thing that we're always a little bit sensitive about. I think when we're helping clients with that, and that was certainly something I helped with in my prior role, but not so much now with IG. We don't generally help with CRA audits. We basically always encourage our clients to go to the accountant to help with that stuff. But anyway, it's just that CRA has a little bit more power to request information, and they could ask someone in the coffee room a question, right? And they're forced to respond. And I would say I'd like them in writing, and I'd like to respond in writing, just so that we know everything that's complete. And there's some interest deductibility limits that will start in 2022. The rules are pretty complicated, and it's mostly for companies that are a little bit bigger. So, nothing to worry about there at this point. They're just trying to protect the tax base, especially when there's, a foreign company involved, things like that. So that's, my high level summary of the overall budget for business owners. So there wasn't anything widespread, very targeted measures, and definitely, some things that I think are looming on the horizon that could be something that could affect you if you're doing some tax planning down the road. That was it in a nutshell. But usually what we get asked about are salary or dividends. Tell me, what the scoop is. And I guess that question to me, because integration by and large works, we're only talking about an overall cost of 0.46%. I'm not necessarily worried about salary or dividend. What I like to say about that is I used to recommend, a blended approach. So, if there's salary to be had, I like building RSP room for business owners, because I do think that business owners who are successful shouldn't turn a blind eye to RSPs as well. It's a good way of extracting money from that corporation, investing it personally. There's, protection from creditors. There's, a nest egg to fund retirement later, things like that. And you don't have to keep a corporation alive, right, to do that. You just have an RSP like everybody else. So I think RSPs are a good thing. So that's why, a bit of salary is good. I also think I've seen people, get in trouble before with just paying themselves dividends and then having a disability claim later in life, unfortunately, and having to justify that they're entitled to compensation from their disability plan because maybe their disability plan doesn't look at or only consider salary, doesn't necessarily look at dividends. So that's the kind of thing I like to say, don't put all your eggs in one basket. It should be probably a combination of, a base salary and a bit of a dividend. We could talk about that a little bit more later. We also talk about appropriate investment strategy. So we know that For example, interest income inside the corporation is taxed so high, so why not focus on capital gains and dividends inside the corporation and focus on interest income in other vehicles like a TFSA or an RSP, things like that. And we're really talking about, asset allocation and asset location when we talk about that stuff. People will always ask us, oh, what's the best structure? And we'll have a couple of comments about that later. But the most predominant question that we get is business owners come to us when they're near retirement and they're like, I've built this business and it's great. I love it. My life's great. I've been successful, obviously, but I don't know what this means to me. And I don't know how I can leave. And I don't know how I can pay for my retirement. Those are the kinds of things. And they tend to hang on a little bit with that as well. And the other question that they have is, well, what does this look like at death? And how will my tax liability be funded? And obviously, we've got strategies for that. So this is kind of the pyramid that we look at. Because we know that investment income is taxed at such a high rate inside the corporation, we do try to look for ways to extract that cash, if at all possible. And in order to do that, we focus on, can you pay out a capital dividend? Can you pay out an eligible dividend? Do you have GRIP? And obviously this asset location and asset allocation thing that we just talked about. So for that, we need the latest financial statements, the tax return, the share register, and the articles of incorporation. And this should always be top of mind for the business owner and the accountant every year. This should be something that's considered. The other thing that we will talk about a little bit is income splitting with family members. So, is there an opportunity to split income with anyone who's been active in the business in the past? And there is income splitting obviously available at 65, but if we have a couple that comes to us and they're both 64 and the spouse that's not involved in the business doesn't have any shares yet, we either have to embark on a reorganization. We would have to embark on a reorganization, give her shares or give him shares. And then, we can't immediately start paying a dividend on those shares without some growth. And so, if you've got business owners that are approaching that 65 and you want to income split with other family members, like spouses, then you need them to have shares. And so the rules that came into play in 2017, they did restrict the ability to income split with children or adult children, but not with spouses at age 65, which is kind of a nice gift to business owners that are retired. And so, then we would need some shares in the non-working spouses' names so that we could, income split with that person. And then we do talk about some advanced strategies. Like we know capital gains, triggering capital gains is one of the easiest ways or best ways to extract cash out of a corporation. So triggering gains, is something that we talk about. Funding an IPP, we'll talk about that a little bit later as well. But predominantly, I would say that the conversation here has to be, what's your exit strategy? How do you plan on selling your business? Do you plan to wind it up, or is there someone in your future who you could see as a potential buyer for your business, or is it your next generation you want to transfer it to? And when those things, when that exit strategy is kind of lined out, then we can really recommend these other strategies. So all of that has to be fed through that same lens to make sure that we, provide them a structure that will work for them, not just today, but also 5 years from now or 10 years from now. So, if I look at the ordering, I talked before about extracting cash. We always look every year at extracting cash tax efficiently. So obviously, if there's a shareholder loan, outstanding, repay that if there's cash to do so. If there's a lot of capital that can be returned, ensure that capital is placed in the hands of the shareholder because they can invest it more tax efficiently personally. Capital dividends, make sure that, if there's a capital gain that's been triggered inside the corporation and you've got a capital dividend account, pay out a capital dividend. And there is an election that has to be signed and filed with the CRA, and the accountant might have to get a confirmation done with CRA to confirm the number, but get that money out of the corporation if you can, and that would be the tax-free way of doing it. The next level is eligible dividends, and your rate on eligible dividends in New Brunswick is quite low. So if you have a company that has refundable tax sitting with the CRA, that will be refunded to the corporation at 38 cents on the dollar. And if it's paid out to someone in the top marginal rate in New Brunswick, they're only going to pay 33% tax on that. So, from a cash flow perspective, it always makes sense to pay out an eligible dividend and get it into the hands of the shareholder. The company will get the money back, and the shareholder will pay less than the company gets back. And then the non-eligible dividend is obviously the last alternative. It's the higher rate dividend, but the same principle there, because they did split the RDTOH account into two. So if you've got non-eligible refundable tax on hand, then the company gets back 38 cents, but you pay 48 cents. Does this still make sense? Probably, but it's your last alternative. So this is kind of the ordering provision that we look at when it comes to stripping out cash out of the corporation and placing it into the shareholders' hands. So, we talked a little bit about this already, but, we do review the business structure with our business owners. Is income splitting possible now, or will it be in the future? And is there anything that can be easily adjusted in the structure that can allow for that, or do we have to embark on a full reorganization? Then, the exit strategy, if we look at, an ability to sell shares down the road, I would say that you would plan for that proactively and make sure that the company is pure, not too much cash sitting inside the company, because if you do have a lot of cash sitting inside the company, selling those shares and taking advantage of the capital gain exemption is definitely more difficult. And I'll show you a structure later where you can multiply the capital gain exemption through the use of a family trust. But basically, you need time in order to be able to do that. So you can't implement this trust structure today and sell 2 years from now if there's not enough accumulation of value between now and 2 years. So I would say that stuff has to be done proactively and pretty early on in the game. Freezing too early or freezing too late. We've all heard horror stories, I think, where someone froze too early and ran out of money, and then felt like they gave their business away for too little to the next generation. Or we've also seen people that have been reluctant to pass that torch to the next generation, and they've held on too long. And by the time that they are ready to let go, maybe the younger generation's like, well, we actually don't really want to run this business either. And so, horror stories all the time with families that are not thinking about their exit strategy at the relevant time. And it is a hard conversation to have. So I don't want to, gloss over that and say, oh, have those conversations. It's the most difficult conversations that you could have with your business owners, right? It's just hard to envision a day where they might not be able to do the work that they love, or it's hard for them to visualize, how it can all be transitioned tax efficiently. So that's where I think good advice comes in. So we do facilitate tough discussions with business owners sometimes, but the questions that we generally ask are, how do you plan to exit? What does it look like when you're not there? Can you sell the company today? Do you have a business owner, or do you have a prospective buyer? What do you think they'll want to buy? Do you think they'll want to buy the whole company, or just parts of it, or just certain assets? So that will dictate if it's going to be a sale of assets or a sale of shares. This is an interesting one. Is there anyone there that does what you do, or could do what you do if you taught them how? That's always a good question, I think, to ask a business owner. And then we do sometimes encounter some assets stuck inside a corporation that the shareholder actually doesn't really want to sell. So they'd like to extract that out of the corporation. But if that's a property that they use personally, I always, I'm a little worried about shareholder benefit. Obviously, if you use a corporate property personally and you only bought it in the corporation because that's where the money was when you were looking at buying that property, you have a shareholder benefit issue, and that should have been included in income. When you're using that property personally. And the way to extract it from the corporation is you have to actually sell it at fair market value. So if there's a large amount of appreciation for that property, people are sometimes shocked. I've been using this property personally. Yeah, I bought it in the corporation, but now I have to pay tax on getting it out, and capital gains tax, and probably dividend tax personally. And if there's a personal property, I would always say have the business owner buy that personally. And if there's no cash personally, then perhaps borrow it and extract the money over time to repay that debt to buy that property. So those are the things that we often encounter when we have these sale discussions. Just two stories about being proactive. The first business owner here won't discuss death and plans to live forever. And it's kind of a sad story actually, because I think that a lot of the next generation was working inside the company, but nobody really knew like how things were going to shake out. And they got older and never owned a piece of the business really, until very, very late in the game. And I think they felt largely not involved as part of the business, for a long time, much throughout their working life. And then when it came time to transition the business, the kids did say like, well, isn't it a little late? Like I kind of am looking at my retirement now, and do I really want to buy this company, and should we just not sell to another person? And that's exactly what happened. But the next generation, there's also a lot of struggles there about well, who's going to be the boss around here? Who's going to have the leadership? And so there's a lot of personality things happening as well. So it would have been good to have more open conversations, but those are hard conversations to have. So that's the kind of stuff that sometimes comes to the forefront when we talk about planning for business owners. The other example is a business owner who actively plans for the future and says, what do I want this company to look like when my competitor, wants to buy me? And he basically ended up buying a warehouse behind his store, knowing that would make his location like the most attractive to his competitor. And his competitor came along and offered him a wonderful deal, and he ended up selling. So he was basically already envisioning what would someone who wants to buy this business need to make it more attractive, and then built the warehouse of that he thought would suit his competitors' needs. So two extreme examples, but be proactive for sure. So one of the things that we like to think about, at least, is does it make sense to do a freeze and bring in a family trust? And the reason for that family trust primarily now isn't necessarily to split income with adult children, because we've got the TOSI rules that were implemented in 2017. But it can be a really great way of multiplying the capital gain exemption, and making sure that the company can, or the shareholders can, take advantage of that. And then what my favorite structure is actually on this next slide, where we actually have one of the beneficiaries of the trust is actually an investco. And so the dividends, if you structure this properly, can be paid up through the trust and into investco, and you can build a bit of a nest egg here for Mr. A and Mrs. A, while you still keep this company pure, so that someone comes along and wants to buy it, they can actually buy the shares, and we can multiply the capital gain exemption here. So this is kind of the Cadillac, and we see this having a lot of applicability. We have a lot of flexibility in this structure. It is probably more expensive to implement. And certainly family trust, there's additional rules that are going to come into place soon. I think it's still proposed, but and it hasn't been enacted. But we do see, that the trust returns for the family trusts are going to become a little bit more complicated. So, it's probably going to be a little bit more expensive, but the flexibility on this structure for most families is wonderful. It's, whether they want to implement a more complex structure and run that year to year. That usually, drives the conversation about whether that's applicable. Just briefly touch on IPPs. And you'll see a little bit later, like why we talk about IPPs, but the IPP can be a really great way of extracting corporate cash and funding someone's retirement. Basically, what you're doing is you're setting up, a pension plan for a shareholder that's funded by that corporation. The one thing that usually happens is it eliminates RSP contribution room. So you're no longer contributing to your RSP, you're contributing to your IPP. You'll have to roll over some of your RSP into that IPP. But essentially what it does is the way that the limits work and what you can contribute to the IPP, it's like a supercharged RSP for a business owner. And that's what they often talk about when they're promoting IPPs. But essentially, you can put away more money for the shareholder's retirement using an IPP than you can for an RSP. And the IPP contributions are deductible. And basically at the end of your life, you've got a couple, or sorry, at the end of your retirement, you have a couple of options when it comes to funding your retirement. Essentially, it's a really great way of extracting corporate cash and setting it aside. But you do need a business owner that is over the age of 40. We've seen most people implement them, in their 50s. Usually that's when the corporation has a steady stream of income that can be used to fund the IPP. And you can do lots of reading on these, but I think that these are underutilized amongst business owners. They're a great solution, for example, for a medical doctor that has a professional corporation with cash in it. Then this is, a really nice way of extracting a lot of the corporate money and setting it aside. And in the context of a financial plan, I've seen these make a very significant difference. And so when I'm talking about a financial plan, we have software that we use to build financial plans. And so everything that we recommend, we always collaborate with the accountants, first of all. But everything that we recommend, for business owners, we can actually measure. So if we see the net estate going up, we know our recommendation makes sense. And if we see it going down, our recommendation doesn't make sense. And so there's a couple of times where we've been able to model the IPP with the help of the accountant and the business owner, and we've seen them make a pretty, sizable difference, a pretty big lift in their net estate, because you're parking more money into an IPP and it's working for you, and it's, obviously tax deferred until you withdraw it. And if you draw it out over a long period of time, and you have a long and healthy life, they can make a really, really big difference. I've seen, some plans where it made like $1 million a difference in the end. So IPPs, don't overlook them for your business owners. And if you need to learn more, there's lots of resources out there for that. So that's really what I help people do is build financial plans. And so, the common questions are, we ask them, are you ready for retirement? And they're like, well, no, like, I don't know. Am I ready? Like, do I have enough? Am I going to be okay? And that's probably the most important question that we can help answer with a detailed financial plan. And a lot of business owners come to us and they're tired of paying taxes, but they don't really know that the money in their RSP is still subject to tax, and the money in the corporation could still be subject to tax. So that's the kind of focus that we have when we work with them to develop that financial plan. So really what the financial plan is designed to do is to give them the financial confidence to step ahead, right? So the plan is reviewed and updated. It should facilitate a more well-rounded discussion about exit strategy. it shows exactly how retirement's going to be funded and taxes paid throughout lifetime and on death. But basically gives, people that confidence. And, when we've worked collaboratively with the other advisors working for the client, it's been a wonderful experience to be able to set that business plan in motion and that financial plan in motion. One of the things that we always talk about is the best tax planning that you can do for anyone. And I always say it's kind of like a piece of bread with peanut butter. You want to make sure that it's covered as equally as possible over as much area as possible, partly because you don't want any year to go unused. You don't want a year where the tax brackets aren't used at all, and you don't want any particular year where you pay a ton of tax either, because then you're facing those high rates. So essentially, we want to make sure that we smooth it out as much as possible, and the planning software will actually tell us, oh, that year this person's expected to be in this tax bracket, and this is the amount of tax they'll pay on their next dollar of income. And so it really lets us highlight those years where there's a bit of a bump or there's a bit of a dip, and then to try to smooth that out either by triggering gains a little earlier or any of that stuff. So this is the kind of stuff that I think people can visualize when they have a financial plan. Making sure that those lower brackets are always used up. Okay, there's a noise there. Just a minute here. So there's a couple of other things that I just want to plug TFSAs. TFSAs are a really big deal for almost anyone as well. But I do see business owners who are wondering about their TFSAs, and I think it always makes sense to take out money out of the corporation and pay it into your TFSA. And the TFSA is still a bit of an overlooked thing, even though I largely disregarded them in 2009 when they were first introduced as well. But now you can actually put quite a bit of money into that TFSA. And I also want to say that if you have someone who hasn't maxed out their TFSA and passes away, that TFSA room or that TFSA can be rolled to the surviving spouse, and they can put that to work for them. But if you've never taken advantage of that TFSA, then you've missed that opportunity. So TFSAs are a big deal, and they can really make up the bulk of an estate in our financial plans. It's not unusual for me to see a TFSA grow to $1 million at plan end. So obviously, it's a wonderful tool that way, setting aside money, and there's no tax consequences to taking money out of the TFSA when you have a big spend that you want to do in retirement. The TFSA can be used to bridge that. So I'm a big fan of TFSAs, and it seems like a minor thing, but they can grow to be quite large. We have a little article here about setting up a family investment trust. I won't go into much detail here, but there's a website here that you can read the article about. You can pick up the article there, but essentially there's a lot of planning right now going on with prescribed rate loans and splitting income amongst family members, and one of the ways you can do that is with a family investment trust. You just be careful about what type of income you earn and who the beneficiaries can be, but you can still use family investment trusts to split income with other people. And then the spousal loan is also something that we talk about regularly with folks. The one thing here is to make sure that you pay your interest every year in cash within 30 days. Because if you don't do that, then you're forever tainted, and the income will attribute back to the person who lent the money to the lower income spouse. So prescribed rate loans, currently the rate's 1%. It seems to work in a lot of scenarios, but it is not for the faint of heart. It should be implemented properly with the right paperwork and the right maintenance every year. And it would be, very, unfortunate if you miss the payment of the interest one year and all of a sudden you fall into the attribution rules and all the things that you were trying to accomplish were lost. So, that's the kind of thing that we also talk about with them. I wanted to give you a bit of I guess, a picture of 2 examples here where we looked at the estate analysis and we provided recommendations, and they, how much of an impact did it have? And so the one is a little bit of a bit of a, I guess, it didn't make as much of a difference, but the guy was doing a lot of good things already. I wanted to talk about that one first, and then the one where definitely, the guy had no plan, and it was very evident. So the first one was a professional who's looking to retire and move, and he was moving from a lower tax jurisdiction to a bit of a higher one, but he always had dreamt about moving. He was living in Alberta and moving to BC, and we talked about, some things like extracting corporate cash now, and then repaying shareholder loan, maximizing that contribution to the TFSA, and then any excess cash was invested in non-registered account, and then your projected net estate was going to be 2.196. We provided some small recommendations like, hey, you should really consider claiming your old age security at age 65, but delaying your CPP, which seemed to work for them. And the projected net estate increased from 2.196 to 2.322. So, not a crazy amount of big difference, but we did talk about triggering some taxes before he moved to BC, things like that. So that was an interesting case to work on. And then the next one was a retired person who was left with cash in the corporation. He had all this cash sitting inside the corporation, but he didn't really know what to do with it. And so what he did was he just lived off of his TFSA and didn't have any taxable income one year. The first year after he sold his company, he didn't know what to do, so he just lived off of his TFSA, and then came to us and said, well, how do I fund my retirement now? Well, he was owed a large amount from the corporation. He had a capital dividend account that could be paid out. He wasn't really investing according to his risk profile. He just parked the money in cash because he wasn't sure what to do with it, so he didn't want to make a mistake. And so, he didn't do anything with that, and he didn't invest inside the corporation either. So he earned the worst type of income inside the corporation as well. He was paying way too much tax on that. And, he'd used his TFSAs, and we said, well, top those back up. That's the first thing, and use the corporate money to do so. So those are the things that we looked at. And here you could see that, we actually had, a crazy jump in the value of his net estate. He was going to be worth 4.5, and after we had implemented our recommendations, he was going to be worth 8. And that's using conservative rates of return. So that's the kind of thing that we wanted to talk about today. I had a couple of other things, but I think I want to leave room for some questions. But there are some recent trends, and you'll read up all about them, I'm sure. But lots of people are wanting to sell their properties because they can't travel to them. So we also layer that into the plan. We get lots of questions about that. And obviously with me being a cross-border or having that cross-border focus, I get lots of those questions. But we will maybe turn it now to the Q&A.
All right. Well, thank you very much, Mariska. That was a lot of really
I know.
pertinent information. So as you mentioned, now is the time for the Q&A. I invite you guys to click on the chat button if you have any questions for the presenter. Il est maintenant temps pour les questions et réponses. Alors, veuillez cliquer sur le bouton chat si vous souhaitez poser une question au présentateur. So I'm just going to start off. I do have a few questions here. You had talked about the 2021 federal budget that IG prepared. Is that something that is shareable, like the special edition? Yeah.
Yeah, I can.
Oh, go ahead.
I can get you that summary with the slide deck. So one of the other questions is, can you get a soft copy? And I'll get that to you guys as well. So we'll get you a copy of the slide deck, and I'll give you a copy of our summary. Yeah, it should be okay.
And this is more a personal question for myself. So as a young adult,
Mhm.
Would there be a good age to start putting money in the registered?
The RSP.
Yes.
Yeah.
Yeah.
Yeah. So what so there's two schools of thought, and one of them is, you know, young folks probably should also think about their TFSAs,
Mhm.
you know, because the the money that you contribute to the TFSA is not deductible. So maybe you want to save your RSP contribution room that you're building for years where you are in a higher tax bracket.
Mhm.
But then there's also the thought that, it's good to get into the habit of contributing to an RSP regularly at a young age. So, I myself took a bit of an approach like that, like, made sure that I topped up both. But if you've got a choice, then I would think your TFSA is probably better off early on until you start kind of making the salary that you think you're going to make for the rest of your life, and you're in that bracket where, and then you start contributing to your RSPs. The one thing that, if you're taking advantage of your home buyers plan, you'll want to contribute to your RSP as well. So there are some things that, like the home buyers plan, where maybe it makes sense to contribute to the RSP and then to pull it out later to purchase a home. But that's the thing. Like, I think it is more than ever. I think, people need to be aware of the tools that are available, especially in this high tax environment. I think, you need everything to be working for you and to fit it nicely together. And I think people sometimes take a bit of an ad hoc approach. Don't blindly live off of your TFSA money if you have no taxable income being incurred, like the fellow that we talked about at the very end there, because that just doesn't make sense, you know.
Yeah.
Um, but TFSAs can be a really great way of putting money aside for something that you want to spend money on later, um, and then you can replace it over time and not trigger too much tax either. So it's the idea that you're really trying to create that smooth taxable income line, no dips and no bumps. Like,
Mhm.
it's got to be smooth as possible, and that's hard to accomplish, especially when you've got something that you're selling. But then plan ahead and make sure, like, which year you're thinking you're selling that, and then if there's anything that can be done to manage your other taxable income, then do that, right? If you're triggering a large gain, maybe you don't have to take a dividend from your corporation that year. So it really is about fitting everything together, and that's why everybody's tax situation is so different, because what they own is so different. But
Mhm.
it's very fun when you see the plans kind of fit together and you see how much of a difference it can make in the end.
Yeah. Um, all right. Well, I don't see any more questions. I was just gonna give people a few more minutes in case. Oh, that might be one here. All right. So someone has just started a business in 2020, last year, with turnover for first year projected at $100,000. However, income is still sporadic during COVID.
Mhm. Yeah.
When would be the best time to start with the tax planning in that situation?
Yeah. So initially, when you're first starting out, I think most people don't think about incorporating just yet. And part of that is because if you have a lot of startup costs and you've got some losses, those losses can be used to offset any of your other personal income. So people generally, the first couple of years, when you've got this sporadic, income level, I would say don't think about, or maybe put that incorporation idea on hold, until you've got a steady stream of income and you can actually leave some money inside the corporation to be taxed later. So that's kind of the golden rule there. But the question also says tax planning, and I think everybody should tax plan. So tax planning to me is more than just looking at an incorporation. It's maybe you can use your TFSA and things like that. COVID has, I think, driven a lot of conversations around, impact. What's the impact of all this to my bottom line? And I think it's hard sometimes to envision, how it's all going to end in that respect, and how long it's going to drag on, things like that. So, for anyone who is affected by COVID, I would really look at those federal programs that were just extended. Maybe this is a good idea, that the hiring subsidy program might be available to you. That immediate expensing that I was talking about before, maybe that's something you want to look at, because that can make a really big difference. If you can write off, the full cost of property against your business income, like that's a really nice thing to be able to do that. So those are the kinds of things that I think anyone should be looking at. So tax planning, I think, is an annual exercise. The financial plan, truthfully, people are so busy running their businesses. Sometimes they don't, give it the attention that it needs. But I'd rather work with a business owner, in their 40s, who, is looking at retirement 20 years from now, than a business owner who says, I would like to have retired yesterday. How do I do it? Right? So, it is working with your advisors and making sure that you're always thinking about, what's my end game? What's my exit strategy? Am I doing something now that's creating flexibility, or am I pigeonholing myself? And that's the kind of conversations that I think everybody should be having with their accountants and with their lawyers and with their financial advisors.
Okay, thank you. We have a few other questions here. I'll start with the first one. What are some of the common mistakes you see with business owners looking to transition to retirement? I'm
dealing with a few where it's just too late. So, if you're approaching your retirement and you haven't thought about transitioning to the next generation, I think that's a missed opportunity. I think sometimes people hold on just a little too long, and then it can be really demotivating for the next generation coming in. And so having an open conversation with your family about what's what, and having that conversation earlier is so important. And I still see missed opportunities there. I don't often see a business owner who froze way too early and ran out of money. That's very rare. It's usually the people that have, they've reached retirement, maybe even past retirement, and their kids are almost at retirement age, and then they start thinking about, well, when do I transition? When are your kids going to be old enough to manage the business that they've been running for 20 years? So that's probably the biggest mistake. And then, I know that people are busy, but I think it is really important to do tax planning, and to kind of forecast like where you're going to be in 5 years, and whether what you're doing today makes sense. And it's easier to just keep doing what you're doing and not give that much attention. And I think that's a missed opportunity as well. But by far, it's waiting too long to have those conversations.
Mm-hmm. Okay, and final question, I'm right on time here. When should they're asking for themselves, when should I start thinking about selling or transitioning out of my business?
I would think that you should probably sit down at least 10 years before and think about it, but start talking to people, at that point. And then by 5 years, you should have a pretty clear picture how you want to exit, and if there's somebody on the horizon. If someone comes to you with a non-solicited offer, at least entertain it, right? Like at least give it some thought, because if that person sees something of value in your business, other people might see the same thing. And if they're saying, oh, I want to buy your shares, well, then a share sale down the road is going to be, on the horizon, or a possibility at least. So what are you doing about that? Or do they just want to buy some assets? Well, then that changes your structure completely. So having those conversations, again, earlier is better. But for sure, I wouldn't want to leave it till, the year before, the 2 years before. But, and I appreciate that life is gray, and that you don't always see that exit very clearly. Take also a look at what your friends in like your competitors are doing. Like, how are they exiting? Is there a conglomerate that's gobbling up all smaller companies? And what do you need to do to make sure that you're not overlooked as an attractive opportunity when that happens either. Or if your desire is to transition to the next generation, then what kind of schooling do they need? What kind of education, like on the job training, do they need to be able to take your place one day? you know and I think you're always trying to create your next, like you're trying to hire someone or replace your own position. Like, that's what your mindset should be, right? So how can I put that person into a position where they can take over and I can actually focus on something else, or retire? Always try to make sure that someone there that is learning what they need to do what you do, so that you can actually create that for that longevity for your business.
Mhm. Yeah. All right. Well, thank you for all those answers. I'm afraid that's all the time that we have. There was a lot of important information crammed into that,
Yes.
40, 45 minutes. So I really want to thank you, Mariska, again for sharing your knowledge with us today. And before we leave off, we have a couple of new webinars already in development in the coming weeks. So stay tuned and be sure to check our website for an up-to-date calendar of events. So I'll leave you guys, and I wish you a good day. Thanks again for attending. Merci encore d'avoir participé aujourd'hui et bonne journée.
Thanks for having me.
Thank you.